Today we'll be looking at Google, also known as Alphabet. I'll be showing you the fundamentals of Google and also using analysts' assumptions about the future to generate price targets. And at the end of the video, I'm going to talk about what I'm personally doing in regards to Alphabet. First of all, Google has had some nice a nice run here, and this is a combination of us staying at home, them providing amazing numbers, and then them buying back shares and them having a lot of moat in this sector area that has driven the stock price tremendously. Let's go back here. The past year they're up 18%, the past 5 years they're up 217%. This is the Class C shares, and those are the ones that I would be buying. First of all, we get hit with a humongous market cap here, 1.7 trillion. Huge market cap means less potential growth. When the company grows, it gets harder to grow. That doesn't mean that this company couldn't turn into a $3 or $5 trillion business, but just something to keep in mind that when a company grows, there's less potential growth, and that means a lower price to earnings multiple that people are going to be willing to pay. The price to earnings ratio is right now 23. Their 5-year price to earnings ratio is 45. So a lot higher there. They have high profit margins. Google, they have their ads that they make money from. They have their search, AdWords. People can advertise on Google, right? And they have their YouTube with YouTube ads, and they have their cloud business, their G Suite with all their products, their maps, their Earth, and their Android. They also own Android. They have the hardware, their phones, Pixels, and their infrastructure that they also have. So, you know, that is just Google, and here the Alphabet has all sorts of other businesses that they own. So probably varies a bit from, but this is the overall profit margin of Alphabet. The price to sales here is almost 7, and they did last year almost 70 billion in cash flow. They don't pay out a dividends. They use all of that cash flow for probably reinvesting back in the business and definitely buying back shares, because we saw that, and that is also one of the things that has been really great at compounding the stock price here over the, you know, this is just buying back, increasing buybacks every year, causing the stock price to boom tremendously. The 5-year return on invested capital is 13%, and that past year it has been even higher, 23%. Return on equity is also high, so they're good at using the money invested into business. That is the return on invested capital. When you invest $100 into a business, they will be able to generate an average over the past 5 years, $13 for you in return, not for you, but for the business. So when these metrics are high, that is something that requires a higher valuation, a higher multiple that you're willing to pay, for example, with price to free cash flow and price to earnings ratios. They go up when you are willing to pay a higher premium when you get something in exchange for that. So now we want to see if the company is actually growing, and I can see here that they grew back 5 years. They did $110 billion in revenue. Past year that was $250 billion, so yeah, pretty much insane. Their profit, they grew from $12.5 billion 5 years ago to $76 billion this past year. Absolutely insane. I don't even know how many doubles that is. We want to see their shares outstanding either decreasing or staying the same. The reason for this is we don't want to be diluted as shareholders of this company. If a company issues more shares, that means your share will get worth less. If they buy back shares, that is doing the opposite. Your share gets worth more, and that is what Google has been doing here. Because you can see 5 years ago, they had 692 million shares, and last year they had 667 million shares. They have been buying back some shares. Their balance sheet, you can see they have $139 billion in short-term cash equivalents and cash, and they have 171 billion in long-term assets, and that easily covers their long-term liabilities. Also their total liabilities, they could pay off their total liabilities with the cash that they have on hand at the moment. So insanely great financial position that Google is in. We want to see that cash flow increasing, and the reason for this is cash flow, that is what is used to kind of also make us investors happy. For example, through dividends, which Google does not do, but share buybacks, which they do, investing back in the business, paying down debt, all these things are what cash flow are used for. So we want to see that increasing. It went from 23, almost 24 billion to almost 70 billion. So they have increased their cash flow massively over the past 5 years, and they have also increased their capital expenditures. So they are also investing heavily into the business or paying down debt or whatever they're doing. But definitely the cash flow is still going up. They still have the cash, which their cash reserve is increasing every year. Here we have the 8 pillars all taken out for us. So we can see that 2 axes here. These are the value indicators. They have to do with the price to earnings ratio and the price to free cash flow ratio. They have a high return on invested capital that is greater than 9%, that is 13% over the past 5 years. We have massive revenue growth, massive net income growth. The shares outstanding is decreasing. Their long-term liabilities divided by their 5-year free cash flow is incredibly low because their debt is well managed, especially when you compare that to the cash flow. Their cash flow is increasing massively, and that is all the checks that we have. And then we have these 2 X's. Does these 2 X's mean that we're automatically going to skip the company? No, not necessarily, because we have the stock analyzer tool, and this helps us put in our assumptions about the future. Here in the 10-year analysis, put in our assumptions, and then we get what we should be paying for Google. We want to go conservative when we make our estimates, but still we want to be realistic. We have 3 different categories here: low, mid, and high. Over the past year, they have done 41% revenue growth. Is that going to happen every single year for the next 10 years? Probably not. We're probably not going to see 20% either, because that is what they've been doing in average if you divide that over the past 10 years. 10 years ago, it was a lot smaller of a business. And as I said in the beginning of the video, when a company grows, it gets harder to grow. Let's put in these assumptions here, because we have a bunch of inflation, which will drive up the cost of advertising 22 and a half. And I have to go, and I want to go conservative here. This is something that I do because I want to find great deals that are great investments. This cash flow and profit margin, they increase because we have been staying at home, and that is not sustainable. We're probably not going to sit back here all our lives. The price to earnings ratio, I put in reasonable price to earnings ratios here, a little bit lower than what they are currently. So this is in 10 years that they will be trading at either 14, 16 or 18 price to earnings. And here for the desired annual return, I always put in 12.5%. The reason for this is you could go out and get an ETF, much safer, much less risk, and then you would get 9 or 10% every year. This is a lot more work also to invest in individual stocks, so you want to make it worth your while by getting a little bit more for your money. Hit the analyze button, and you can see that we're not there yet. I would also say that these assumptions about revenue growth are probably too low for what I would be comfortable with myself. I would be comfortable with like 12, 11, and 13, but still my price target is around 2K. That is where I'm comfortable. So if they were to stay at this price of 2.665, just like that, and they were to do those earnings and they do this EPS of $115.88 per share, 115.88, that gives us a price to earnings of around what they're at right now. So if you think that they'll do these estimates, I also do think that the current price to earnings is really low, to be honest. 23 is not something that you see Google trading at very often. So that is maybe what has made Learn to Invest, the host, go in on this investment. That might be the case. I would like for it to go down a bit more before I start buying. But let's examine the next year's EPS here, and this is the average from 42 analysts. And let's say that they do those estimates and they keep this price to earnings ratio of 23. The price would be a little bit higher, but this is their price the price what they're worth, the stock. That is not considering that we want a 12.5% annualized return. So that is why you have to remember that these estimates that I have in here, and these are with a lot higher growth than what I initially put in. But these assumptions, basically you should be buying at this price if you wanted 12.5. Oh yeah, if you want a 12.5, if you want a 12.5%, yeah, whatever I did, you should be buying at these prices if you believe in the assumptions and you want a 12.5% annual return. So that is another catch, right? This is just looking at their price relative to their EPS, right? So I think it's a phenomenal business, Google, and that is why I have it on my watch list. $2,000, I definitely want to be a buyer if it goes there. If it doesn't, then I'm okay with it. But I do think it will go to around $2,000 if we do get some more fear, some more recession-y vibes. I do think that is possible. I hope you enjoyed this video. If you did, make sure to go and like and subscribe. It's just down below. You just gotta do like that and then click the button. It's very easy and it really helps me out. With that said, I hope you have a great rest of your day. Bye bye.